So thank you everyone for staying for the last talk. I'll say thank you to John and Sita. This is a continuation of their work. And to Jason Scott from Financial Engines. He gets all the credit for framing differently this topic, and we'll show you slowly the new framework. I'd like to thank Kathleen and the Sloan Foundation for their support and for funding this conference. So the Social Security puzzle. So as Sita and John have shown and other research is that delaying Social Security is actuarially advantageous for most individuals. It's a very good deal for the primary earner in a couple. It's a good deal for single male and females. And it's a fair deal for the secondary earner in a couple. And yet still, most people claim Social Security early. And we ask why. And it could be a mistake. But it could also be, for some individuals, there is a good reason, because maybe they're healthish, they have very poor health, maybe they have time preferences or bequest motives, and other reasons to make it that for them it's not a mistake. For them it's a good reason to claim Social Security early. And the paper today that I will show you is that we're talking about the people that we can definitely say that they're making a mistake. Now, economists don't like saying someone is making a mistake, but this paper is going to say a portion of the population is definitely making a mistake. So in this table, I'd like you to see two columns. The first is the column that has the percentage of people claiming the retirement Social Security benefits. And at age 62, the youngest age that you can claim Social Security, it increases to 16%. And as the age increases, the percentage of people claiming Social Security also increases, and by age 66, which is today the normal retirement age, it already goes up to 85% of the population. And then age 70 is the maximum age that you can claim Social Security, and so most people, as we see, are claiming Social Security before the maximum age. The second thing that I'd like you to notice is the last column. That is the percentage of people that are taking both Social Security and some type of pension or an annuity. And if we look at the age of the population that is at age that they can defer Social Security further, there is quite a significant population that is taking both Social Security and an annuity. By age 64 and 65, it's a quarter to a third of the population. So these are millions of people that are both taking Social Security and an annuity. And our paper is going to focus on that population and say that many of them are making a mistake. And why are they making a mistake? Because they're taking a dominated strategy. That the alternative strategy that they should be doing is, instead of taking the pension as an annuity or buying a retail annuity, they should use that money and defer Social Security further. We're going to generalize this argument for both singles and for primary earners in a couple, and we're going to consider the case for DB and defined contribution plans. So before we work to the general, let's understand very carefully illustrative example. So suppose you're a single male, you're at age 66, and your Social Security benefit is $12,500. And you have a very simple objective. You want to increase your real annual income by $1,000. So you have two ways to do that. One way is to go out and buy a CPI-indexed annuity for $1,000. We get a quote for that, and it's going to be $22,290. And at the same time, you're going to commence Social Security. So the total, this alternative will cost you the cost of the annuity. And then there's another alternative. The other alternative is that don't buy the retail annuity. Instead, defer Social Security by 1 year. 1 year would increase your Social Security by 8%. 8% of the $12,500 is exactly that $1,000. And the cost of this alternative is, first of all, the $12,500 that you're not getting from your Social Security, and another $1,000 which you're sort of paying yourself that you would have gotten that from the retail annuity if you would have chosen alternative A. The cost difference between these two alternatives is $8,790. And what I really want you to understand is that both alternative A and alternative B are the same financial asset. You're increasing your annual income, your real annual income, by $1,000. But the cost is very, very different. And what have we learned in our finance classes? That's arbitrage. To just have this one more time very clear, so I plot here the cash flows of both alternatives. In alternative A, you're getting in both alternatives $13,500 in both of these cases. Just that in alternative A, that is composed of two different sources, $12,500 from Social Security and $1,000 from the retail and annuity. And in alternative B, after that first year of deferral, the $13,500 is all coming from Social Security. But then the first year you're getting your $13,500 from your pension funds. It's from your saving funds. And then again, the alternatives cost very differently. So now that was the single case. Now let's consider the primary earner in a couple. So that you see in this bracket. And the cost for a 100% joint and survivor and annuity in the retail market would be $28,547. And so this would be the most comparable financial asset to Social Security, because if you're a primary earner in a couple, delaying Social Security is the second to die in annuity. In the second row, we're showing the quotes that you would get if you'd want to buy a nominal retail and annuity. And in the last row, we show the present value of a DB lump sum value that you would have gotten. Now, the IRS gives you the interest rates and the mortality rates that you need to use to calculate the DB value. So then, so we show those numbers for an annuity, an annual annuity of $1,000. Now, whether you have a defined contribution or a defined benefit plan, whether you're a single or a couple, still delaying Social Security by 1 year costs the same, that's $13,500. So we take the difference, and here in red you see the arbitrage gains that you can make by deferring Social Security by 1 year. Now I want to make it clear that the first row is the most comparable apples to apples between Social Security and the retail and annuity option. The second row and the third row are not as comparable because they're not protecting you from inflation. So if inflation is positive, the Social Security and annuity is much more valuable than the nominal DB or retail and annuities. So this was the case for 1 year deferral for an earner of age 66. Now suppose you're at age 62 and you are a primary earner in a couple. And your Social Security benefit is $24,000. That's almost the highest. And you have an objective of increasing your annual and annuity by $18,420. Sounds like a weird number, but you know where I'm going at. You're deferring by age 62 to the maximum age 70. Your Social Security benefit will increase by 76%, and that's exactly $18,240. So alternative A, you go out and buy a real retail annuity of $18,240. We get a quote for that, and that's almost $600,000. You're going to commence Social Security at age 62, and then the total cost of this alternative is then annuity cost. On the other hand, you can go and not buy an annuity, the retail annuity, and instead defer Social Security up to age 70. The cost is your total annual income that you wanted. That's $42,240 for 8 years. Altogether, that costs you $337,920. So the difference is almost $250,000. This is quite substantial, and to get a magnitude of it is also that you can go out and buy with almost $250,000 an additional real annual income of $7,727, increasing your annual income by 18%, or even 32% if you look at the benchmark initial benefit. Now, this is actually not the maximum that we can talk about, because there's, if you're a couple and there's a very large age gap between the primary and the spouse, then the retail and annuity, this number here, would be much, much larger, because then the insurance company is expected to pay much for many more years, and then the difference would be much more. So now let's generalize this. So we're going to consider singles and primary earners in a couple. We're going to consider male, because if this is true for males, it's definitely holds for females. we're going to consider, we're going to assume zero inflation. This is like a very conservative assumption because it works against us. So if our claim holds with zero inflation assumption, it's going to hold even stronger for when inflation is positive. And next, we're going to, for all cash flows after the deferral period are going to be by construction the same, and then we just need to compare the cash flows during the deferral period, and we're going to use discount values, discounting nominal cash flows with the nominal rate and real cash flows with the real rate. Okay, so now alternative A, we're going to consider three alternatives. First is a real annual income. The second is a nominal retail annuity, and the third is the DB annuity. And at the same time that you're taking these annuities, you're also commencing Social Security. And alternative B is going to be that if you have a defined contribution plan, you're just keeping your money at the 401k or IRA. Or if you have a DB plan, you take the DB lump sum, and you're going to defer Social Security by 1 to 96 months. Of course, if you're 60, you can't defer to 96 months, so we're going to look at the maximum months that you can defer. Now, the color scheme that you should have in mind, black means that there's pure arbitrage gains that can be made, moving from alternative A to alternative B. This shade of gray would mean that moving from alternative A to B will be an out-of-pocket of up to 5% of the alternative A value. And last is up to 10% of the alternative, of the value of the alternative offer, and then moving to alternative B. I'd like you to, we'll talk about the shades of gray in a second, but our paper is mostly about the black. We're considering those pure arbitrage gains. The people that we see that choose A when they could have chosen B are making a mistake if it's a black cell. So in all the graphs that we're going to show, there's the same scheme. So on the horizontal axis is the months that you can defer. On the vertical axis is the age. So every single cell in this top triangle is a combination of age and deferral months. So in the top, and then on the right we have primary earners, and on the left we have the singles. So in these two graphs, we're comparing between alternative A, the real retail annuity, versus moving and deferring Social Security with those funds. And what we see is that the cells are all black, both for primary earners and for singles. There is pure arbitrage gains moving from not buying a real retail annuity and instead using those funds to delay Social Security. So the main takeaway of this is just simply that Social Security is a really good deal, that it is trade, that the value that Social Security is offering you is much lower than what the insurance companies would offer. The next is we're comparing between the nominal retail annuity versus delaying Social Security. What we see for primary earners in a couple is that all cells are black. So it is pure arbitrage moving from alternative A to alternative B. For single males, most of the area is black, and then some of the areas is the other shades of gray. So that would mean that you would need to move from alternative A to B, to deferring your Social Security, you would need to pay out of pocket. But think of the fact that moving from alternative A to B gives you two quality upgrades. First of all, it's giving you the inflation protection, and it's also giving you a credit quality upgrade, moving from an insurance company, a private insurance company, to the credit risk of the US government. So at the cost of 5%, you may think that that's a very good deal. And what we take from these two graphs is that in contrast to what we always say people should be taking annuities, buying annuities, we're actually saying that if they had the option of taking an annuity and they had the option of delaying Social Security and they didn't, they're making a mistake. That it's much better to delay your Social Security and not take an annuity versus the alternative. Last, we're going to compare to the DB annuity. And we see that for primary earners in a couple, most area is black. Some area is the shades of gray. For singles, it is not such a clear cut, and there are mostly areas that are not black. So for those, they're the only ones that we can say that there is almost no arbitrage gains to be made. So again, in contrast to what we think, also for DB employers and employees, there's a lot of criticism for those that are offering DB cash outs. But actually, that might be a good idea if with that cash out value, they're going to be deferring their Social Security further. So now a bit about tax considerations. So there's implications for the two alternatives that we offer. There are different tax implications. So Social Security is the amount that is taxed varies depending on your other income. And it can vary from 0 to 85%. Now, in the two alternatives that we offer, it's shifting around your income, so it can have an effect on your taxes. So think of this as a timeline. There's the deferral period, and then there's the point that you claim Social Security and everything after. So just as an illustration, suppose that the Social Security and your other income is equal across time under Alternative A. And then in Alternative B, we're shifting your Social Security income to the later years, and your other income, we're shifting it to the earlier years. So in all the exercise that we're going to do now, we're going to make it that the total income after tax for the deferral years is going to be equal in Alternative A and B, and then we're just going to need to compare the cash flows at after you claim Social Security. And the net tax gains is going to depend on your other income. So we're actually we're adding another dimension to our analysis, which is how much your other income varies. So we're going to compare moving from Alternative A to B. We're going to consider just one case, an age 62, singles and primary earners in a couple. And we're going to vary the income range from 0 to $100,000, annually, of course. And then Alternative A, we're going to show you here just the real CPI indexed annuity and commencing Social Security immediately, versus Alternative B, keeping the money in your IRA fund and delaying Social Security to the normal retirement age of age 66. In the paper, you could see also the case comparing to the nominal retail annuity and to the DB plan. So in this graph, in the horizontal axis is the range of other income from 0 to 100,000. And on the vertical axis is the percentage increase in your net after-tax income as a percent of the primary earner's Social Security benefit. And what you see is both for singles, which is the gray line, and for primary earners in a couple, that's the blue line, it is way above the 0. So that is that moving from Alternative A to B is pure arbitrage for all income ranges. We also see that there is somewhat of a hump, and that is because of the changes in how much your Social Security is going to be taxed. And we see that for singles, it's below the couples. So to conclude, first of all, we've shown very clear that there's risk-free gains to be made by delaying Social Security. This is a much stronger claim than what has been shown before, that it is actuarially fair. Here we're showing there's clear-cut gains to be made. Second, we show an unexpected recommendation, which is don't buy an annuity if you are not going to plan on delaying Social Security at the same time. We're showing that there is 25 and even more, a large percent of the population that is choosing this dominated strategy. And we show that, that this mistake is large. It can even increase your annual income moving from Alternative A to B by 18%. And last, we have shown that this holds also once you consider the tax implications of the two alternatives. So why are people doing this? Maybe our discussant will have something to say about this, but we're thinking the simplest answer is that it's a very complicated question. I see some faces here that maybe it still needs to sink in what we're showing. So what can we expect from the layman person? And they need to understand the real versus nominal. They need to understand second-to-die annuity concepts. There's many rules to Social Security that it's just very complicated, And when someone offers you the default, you just accept it. Second, they might be just getting the wrong financial advice, both from the Social Security Administration and from their financial advisors. And last, there might be misconceptions of survivor and spouse benefits that complicate the question. Thank you very much.